Canada's economic performance since the pandemic has sparked much debate, revealing a complex picture of growth and stagnation. While the country's GDP has seen an uptick, this expansion has not translated into significant gains in GDP per capita. In fact, recent statistics indicate that productivity growth has not only stagnated, but worsened since the pandemic. As of Q3 2023, output per hour worked remains below pre-pandemic levels, highlighting a troubling trend that has persisted since the 1980s. Historically, Canada has enjoyed a reputation as a robust economy, often recovering swiftly from global downturns. For instance, during the 2008 financial crisis, Canada experienced relatively minor GDP declines compared to its G7 counterparts. However, the current economic landscape reveals a more sobering reality. While Canada has managed to grow its GDP at rates higher than many developed nations, its per capita income has stagnated, leaving many questioning the sustainability of this growth model. Immigration has played a significant role in driving GDP growth, with Canada becoming one of the most welcoming countries for newcomers. In 2014 alone, over 250,000 immigrants made Canada their home, and by 2015, more than 1 in 5 residents had been born abroad. Yet, this influx of workers has not spurred the expected productivity improvements. Instead, the majority of recent GDP growth can be attributed to the sheer increase in the labor force, rather than enhancements in productivity or innovation. This brings us to a critical juncture. What has led to this productivity stagnation? To answer this, we must look back at the trend starting in the 1980s, when Canadian productivity levels began to diverge from those of the United States. Despite being a nation rich in resources and opportunities, Canada has struggled to capitalize on its potential. The productivity improvements that once characterized its economy have largely disappeared, raising concerns about the long-term viability of its growth trajectory. In a world where high productivity is key to economic resilience, Canada's reliance on immigration, without corresponding advancements in productivity, signals a need for a fundamental reassessment of its economic strategies. As the nation navigates this challenging landscape, the interplay between immigration, investment, and regulatory frameworks will determine whether Canada can revitalize its economic engine and reclaim its status as a leader among developed nations. So in today's video, let's take a look into the Canadians' economic challenges. Investment challenges are at the heart of Canada's economic stagnation, revealing a landscape where capital accumulation has faltered significantly. A robust economy relies heavily on substantial investment in essential infrastructure and technology, elements that are crucial for boosting productivity. Unfortunately, Canada has seen a marked decline in such investments over the past few decades. This lack of focus on acquiring modern machinery, advanced computing, and necessary network infrastructure has hindered the nation's ability to enhance its productivity and overall economic output. Entrepreneurship, a vital driver of innovation and growth, has also been stifled in Canada. The business environment is often described as timid, with private investment levels lagging behind those of many other developed nations. This cautious attitude among Canadian entrepreneurs limits the potential for economic expansion, as fewer individuals are willing to take risks with their savings to start or grow businesses. In fact, Canada's private investment levels are alarmingly low, currently below 50%, setting it apart as one of the least entrepreneurial economies among its peers. Adding to the woes is the significant drop in foreign investment. Since 2000, foreign capital inflows into Canada have plummeted from over 9% of GDP to less than 3%. This decline is not just a fleeting trend. It represents a staggering loss of $225 billion in foreign investments since 2016 alone. Regulatory barriers are frequently cited as a primary reason for this downturn, creating an environment that dissuades both domestic and foreign investors from committing capital to Canadian ventures. The combination of a shrinking business sector, low private investment, and diminishing foreign interest has created a perfect storm, leading to a worrying decline in economic vitality. As Canada grapples with these investment challenges, addressing the barriers to entrepreneurship and fostering a more welcoming environment for investors will be crucial for revitalizing its economy and ensuring long-term growth. Without such measures, Canada risks being left behind in an increasingly competitive global market. Overregulation and state intervention have become significant barriers to economic growth in Canada, creating an environment that stifles both domestic and foreign investment. The sheer volume of bureaucratic red tape has turned regulations into an oppressive burden. While regulations can play a positive role in ensuring market stability, excessive regulation often feels like a heavy snowfall, initially beautiful but quickly transforming into a dangerous avalanche that suffocates innovation. Canada stands out for its restrictive environment, with regulatory barriers nearly 3 times higher than the OECD average, making it one of the most closed countries to foreign investment globally. One glaring example of this regulatory overreach is the dairy and poultry supply management system, which imposes strict quotas on production. This system keeps prices artificially high and hampers free trade, illustrating how regulations can hinder market efficiency. Furthermore, internal trade barriers among provinces add another layer of complexity, costing the economy an estimated 20% increase in import costs per province. This bureaucratic maze effectively creates a market environment that is more closed than even the European Union. The impact of these regulations is not just seen in investment levels, but also in the sectors that are struggling. Canada has experienced significant deindustrialization since the early 2000s, with the manufacturing sector, a crucial contributor to high value-added economic activity, shrinking from 17% of GDP to less than 10% over the past 2 decades. This decline reflects a broader trend where investment that does exist is often misaligned with the country's best opportunities. Notably, Canada spends less on research and development than most G7 nations, with only Italy spending less, highlighting a troubling lack of innovation. As the regulatory climate grows increasingly stifling, the result is a reluctance among entrepreneurs to invest in high-risk, high-reward sectors like technology. Canada's share of high-tech exports has dwindled significantly since the 2008 crisis, a period marked by escalating government regulations and investment restrictions. The combination of high taxes and strict regulations makes it increasingly unattractive for investors to engage in dynamic markets, forcing many to retreat to safer, less innovative sectors. Compounding these issues is the talent drain facing the country. With proximity to the U.S. offering Canadians access to one of the world's most competitive labor markets, many skilled professionals are leaving for better opportunities south of the border. In a stark contrast, data shows that while only 10,415 Americans immigrated to Canada last year, a staggering 126,540 Canadians chose to move to the U.S. in search of higher salaries, better career prospects, and lower taxes. This outflow of talent not only leaves Canadian companies struggling to fill high-skilled positions, but also represents a significant loss of expertise that could drive economic growth. Ultimately, Canada's business sector has been eroded by decades of overregulation and government intervention, resulting in stagnant productivity levels and a challenging economic landscape. Without meaningful reforms to reduce bureaucratic hurdles and foster a more entrepreneurial environment, Canada risks falling further behind in a competitive global economy. The path forward requires a concerted effort to create a regulatory framework that encourages investment and nurtures innovation, ensuring that the country can capitalize on its vast potential. In summary, Canada's path forward demands courageous reforms and targeted investments aimed at revitalizing its economy. By addressing these fundamental challenges head-on, Canada can not only navigate its current economic difficulties, but also position itself as a frontrunner in innovation and productivity on the global stage. With a commitment to fostering a dynamic business environment and harnessing the potential of its skilled workforce, Canada has the opportunity to redefine its economic landscape and drive sustainable growth for the future. With that, let's end the video. This is Visionomics signing out.